semi-active equity investing, as I mentioned before, become more and more popular in financial community, especially in the equity market. And what is the main features of this type of approach? Well, the purpose in here actually is try to beat the market. In other words, seeking for an outperformance, all right, but given a benchmark so that able to control the tracking risk and then simultaneously. So the purpose is that to control beta and seeking alpha. So I probably will summarize this is the semi-active is control beta and seeking alpha. So I would like to do here is just say using the U-turn X, which is based on Chow ratio as example. Is I create an index on that. Its same features is controlling the beta at the same time and is seeking alpha. So to do that, implicitly or explicitly is using this information ratio concept. It's a ratio concept, meaning that you like looking for the maximize your alpha at the same time minimize the risk. So let's go over this information ratio one more time. We have discussed that before. This is a ratio. You think about it. The ratio meaning that the smaller the denominator, higher the ratio. Even the numerator itself are equal. Okay. Now suppose you and me are competing each other. Suppose we all generate the same alpha, but the portfolio I have here had a lower standard deviation of the active return. Remember, this is the active return, not the return itself. The active return is that it's return of the portfolio over the benchmark return. So that's an additional return. Same with the alpha. Alpha is the return of your portfolio, expected return of your portfolio minus the expected return of the benchmark. So if your alpha is same with me, but I have a lower risk, all right, or the volatility of my active return, then I have a higher information ratio, then I beat you. So in fact, all those fund managers are chasing each other. They are trying to maximize the information ratio. The ratio I have here, called Chow ratio, had a similar concept with the information ratio. So I'm looking for the stocks that give me the maximum alpha, right? At the same time, I will looking for the smallest volatility of that alpha, of the excess return. Okay, so this is the goal of that. So I like you to, even though I spent time here, a lot of people overlook that, the power of the information ratio. Now, in terms of English, all right, so the semi-active equity investing, like I have this called the short-term reversal strategy, is this: is a manager make use his or her investment insight, while at the same time to neutralize the portfolio risk character or characteristic that inconsistent with those of the insight. So in other words, I have an insight. I know I can catch the short-term reversal based on the stock selection that have a negative return in the previous periods. However, I like to do is to neutralize some of the risk, right, characteristic. Even though I select a pool of the short-term, the target asset will give me the short-term reversal, but there's some kind of deviation from that, my insight. But I want to control that risk, so I neutralize that. It's the same thing here, is to maximize the information ratio. This is a relatively new philosophy of portfolio management. All right, fund manager need to understand that. To reach this goal, right, the semi-active investing strategy goal, you have two approaches. You can use stock base, like the Chow ratio approach, or you can use derivative base. And then this derivative base is same with the stock selection, but it's a synthetical approach. All right, so this is synthetical using derivatives to reach the goal. Now, for stock selection approach is direct. So, in other words, you are going to do stock selection, say an S&P 500 stock, this investment population, but you don't use the whole 500 company. Then you try to do here is to select the stock, a subset of that. Then you view that one, it will outperform, all right, the index. Now, of course, you can outperform meaning you generate alpha. So So in other words, you based on different type of your model or bench or design, all right, to do that one. In this case, you could be use a fundamental information, or you can use a quantitative approach, all right, or statistical approach to do it. But anyhow, you're looking for something that you view that one, it will outperform or underperform, but it's going to allow you to generate alpha. So this stock selection is the core for achieve that goal. But at the same time, you know the selection, but also you have to control the risk exposure. So that actually is combining together. Is that you select the stocks who are able to provide you the alpha. At the same time, those stocks had a minimum, all right, alpha volatility exposure. That's standard deviation of alpha. So you can control that, all right, with this at the same time. So that will achieve your goal. On the other part is you may use derivatives. So in other words, you don't want to use the stock buying the stock because the rebalancing of a stock may cost you more in terms of transaction and trading cost. So you may consider use a derivative. And using a derivative, there are two purposes. One, you want to generate alpha. Suppose you want to generate alpha. If you want to generate alpha, what do? Is that you hold your core portfolio. Suppose you already have an S&P 500 index portfolio, like SPY, but you view that I'm not just keeping the beta, I want to generate alpha. So we have discussed that before. You can do is to enhance your return by, for example, by an index futures, or you can short a call, or you can buy the put, right? You can short a call, you can short a put if you view that stock's going to increase. If you stock's going to decrease, you can short a call, and you do this kind of so-called a market trend or timing approach. Okay, this is called alpha generating from derivatives. On the other side, if you want to generate some alpha, but at the same time you want to keep the liquidity, you can use the way that you can just say, okay, now because market is crashing, all right. So, but I if I sell the stock, I will never get back my holding, but I need the cash. So what I do here is I go ahead sell the stocks, but at the same time I buy the long-term call option. Okay, so because long-term call option is cheaper. So for example, I can sell the stock at $100, but I want to, all right, buy and call option has a strike price, all right, and but it's say suppose this will be like 6 months or 1 year long-term contract called lips. So I don't have to spend, I can just sell $100, but I take another maybe like $35 or $40 to buy that. So I still can generate around $60 cash on hand. But I would not lose that, all right, the stock position because I have a call option. And a call with a long-term call, you know that if this is even this at the money or maybe in the money, then you still have this called the your delta position. Your delta, if it is in the money, like $100, you buy another like a $50 car, right? So you will never lose it because it's $100 because you have $50 exercise price. That means that what happened to this is that when the market start moving, your call option moving the same pattern. So this is called delta equal to 1 position. Well, when you learn a derivative, you're going to see that more about this. But anyhow, selling the stock, buying a long-term call option will provide you liquidity. Now, let's just summarize here, right? The two approaches. The stock-based approach, which is a security selection, that is going to generate alpha. You control and the undervalue or underperform and overperform security, and then you can actually approach to pick up the active return through the your equity insight. Where the derivative-based approach usually is to equalize the cash, or at the same time you provide a liquidity. For fixed income position, the derivative base also pick up the active return by adjusting the duration of fixed income position. We're going to discuss the duration position in later on. Duration is a very important part for measuring the interest rate risk. In other words, the derivatives approach can be used not only in the equity market, but at the same time, it can also be used in the fixed income part to minimize its interest rate risk exposure. Now, let's focus on the information ratio one more time. Okay, the information ratio provides us a law of active management. Okay, active management. Let's review this information ratio one more time. This is a very important measurement here. So information ratio is risk-adjusted active return to the benchmark. It's adjusted active return. Now remember, there's two terms. One is called active return, and another one is the risk-adjusted. All right, the active return is the excess return to the benchmark. The formula we already discussed is alpha over the volatility of the active return, where the active return is the differences between the return of your portfolio and the benchmark's return. So in other words, if information ratio is zero, right? Zero, that means zero alpha. So zero alpha meaning what? The expected active return zero, meaning there's no tracking error. All right, no tracking error. In other words, if you want to generate alpha, all right, you must allow that tracking error exist, right? You have to let them exist, the tracking error. But the tracking error is a risk, so we want to minimize that tracking error. That's the reason we got this information ratio. So maximize information ratio is to maximize the tracking error risk adjust active return. Okay. So make sure you understand that. This is a very powerful measurement. The two researchers, the Grino and Ken, they have a mathematical derivation. They found that the information ratio actually very interesting. It combining as two important indicator. One is called the information ratio coefficient, and then the other one is the investor breadth. Okay, investor breadth. The interesting one is this: the IC indicating is the predictability, the ability to predict the outcome. So in other words, here is that the IC part is what you know about given investment. All right, and it's had, well, let me see that. What you know about given investment, what do you mean your prediction power? All right, so the more skilled managers had a higher information coefficient. Okay, high information. So that represent the measurement of the management forecasting or prediction skill. Okay, higher the IC, more power, more higher the IR. Okay, so it's more if you the manager had a more prediction power, then you have a high information ratio. The other one, IB means number of independent active investment decisions made each year, meaning that how many times you do that prediction. Okay, how many times? The more you do and more accurate the prediction is, higher the information ratio. Okay, now here, so this is the way to analyze the managers, right? So because the manager is the one for most of the foundation insurance company use, so they select different manager. Manager means different fund. The first fund manager follow the stocks, 500 stocks. So it's a number of stocks or number of the prediction, and the prediction power it's about say 3.003. All right, so IB times IC, we got this 0.67. All right, so for the portfolio manager B, the B managers had 100 trial, 100 stocks, and IC is a 6. So this one we got the 60, right? 60 out of 100. So which means that the portfolio manager A, all right, manager A had higher IR, so you probably will select that. So this becomes a selection purpose. Um, it doesn't mean that the A actually is more skillful, but the A had a higher number of trial. Okay, and the B actually had a higher skill, but had a lower trial. Right. So it's a balance between the IB and IC. But my viewpoint here is that even though this law can give us some kind of selection benchmark or criteria, but this measurement ignore the transaction costs and liquidity and transaction costs. So like manager A, even though it had a high IR information ratio, I may not select that because you're following 500 stocks. So if you're doing the rebalance, your cost is high. And what about if those stocks are smaller stock? All right, smaller stock, so you will have a higher transaction cost and low liquidity. So when you use the IR, you have to consider the transaction cost and liquidity risk simultaneously. So this is another one. If it exam, I ask you question: what is the limitation of using this IR or the law of active management? You need to consider that two factor: transaction cost and liquidity. All right. So we have to be careful.